So my name is Gilles Metetal. I have been the head of the agribusiness department of the EBRD. EBRD is a European Bank for Reconstruction and Development, which is a bank that was set up by countries. It's an international organization. Was set up for helping Eastern European countries get out of the communist and move to a market economy. The agribusiness became a very, very important department, which was committing about $1 billion every year to the private sector, to private agribusiness companies, from supermarkets to farms. And I always say that in that order, because you start with the demand and then you go to the supply. That's what the private sector does. I left EBRD in 2017. Now I'm on the board of a few companies. One of the company is the biggest exporter of grain in Ukraine, called Nibulon. With a few members are participating to the conference. Another company is called Astarta, which is a 240,000 hectares farm listed on the stock exchange in Warsaw. I'm also the chairman of the investment committee of a private equity fund, and eventually, finally, I'm advising the Asian Development Bank agribusiness team for their investment in Asia and Central Asia. What I wanted to tell as a starter is that for me, since I started financing agribusiness, the biggest problem was always the working capital. When you go to the shareholders, when I presented projects to the board, which were the countries of the shareholders of the EBRD, they were always quite upset when we were doing working capital, because they felt that it's not like hard investment. It's not like building a factory, something that you can see, something that is tangible. And I used to say that agriculture is about investing for 1 year. You invest by seeding, and then you collect, you get your benefit once, by harvesting. Without working capital, agriculture cannot exist. So the challenge has always been to find ways, first of all, to convince our shareholders that agribusiness is, agriculture and working capital is important, but also to find ways to do it. And the problem we had is very simple. It's in most emerging markets, and that's probably the case in Africa, and that was the case in Eastern Europe, land ownership is not very transparent. Mortgages don't exist, titles are weak, and as a result, banks don't accept land as a mortgage. And that's a problem. The number one problem is that. So we have to find ways around it. It's like if you were buying a flat and you cannot, get a mortgage against your flat. Not many people would be able to buy flats if that was the case. Well, it's exactly the problem that agriculture finds. Many countries, like in Northern Europe, and in the US, got around it by creating rural credit cooperatives that became the biggest banks in the world, because their assets were very strong. Although they were not used as a collateral, but they put the assets together into a bank to create Crédit Agricole, Rabobank, Raiffeisen Bank, Unicredito. That was really, a major achievement of the agriculture sector. So the way around, we looked at various ways, and I would, list a few options. The first thing we did ourselves was to finance mainly vertically integrated companies. Because when you have a company that is producing agriculture and transforming agriculture through a factory, you can take a mortgage on the factory and then use the factory to finance the agriculture. And that's what we used to do. Then we tried to introduce dedicated schemes like warehouse receipt program, where basically you use your harvest as a security and you deposit the harvest into licensed warehouses, and that allows you to go back to the bank and get cash. That was hugely successful in countries like Kazakhstan, in Bulgaria, in many countries. And then the IFC and the World Bank took that in a number of countries, I'm pretty sure in Africa, and that's what we were doing. Then, we tried to introduce a concept that was developed, a lot in South America, and particularly in Brazil, to take the future crop as a mortgage, through what you call a crop receipt program. And that was really another way to go around the problem and then to inject the liquidity. And of course, by the time also that some companies, build a reputation, this is the case for the companies I'm working with, for example, Nibulon, which is raising, millions of dollars every year to buy the crops in the country. You build a credit history, and then, of course, banks become comfortable because, the companies are reliable, or have been reliable, and they can build on the history of this bank. But very often in agriculture, before you have the history, and if you cannot use your land as a mortgage, you really have, some difficulties. There is another model that is coming up, and I was just really approached on that recently, which I think could be a very interesting way of also, thinking about injecting liquidity, is virtual currencies, is crypto monies, as we say. It's the capacity to, issue non-fungible tokens against land ownership that would allow the farmer to to create some liquidity in the system, sell these tokens, and then in return provide a part of the harvest to the owners of the token, and then with that create liquidity. Finally, very interesting. I work a lot in a country like Ukraine. Ukraine was probably one of the best successful development in agriculture in the world over the past 50 years. Why? Because it's a country that was barely self-sufficient. They were actually closing border because they felt they might not have enough grain to feed their own population. Today, it's the third biggest exporter of grain in the world. They increased yields in a tremendous way. They invested a lot in the production. And the only reason behind that is because land ownership is not allowed, and land can only be leased for a long time. There was a moratorium of land ownership, and then basically land could only be leased. So farmers, instead of injecting money and buying the land, they were able to actually just rent the land and then inject the money in improving that land. And that was the reason behind the success. So the working capital financing, and of course, I don't talk about trade financing, and I don't talk about all the structured financing scheme that can be available, but this is a real key issue that brings back to the ownership of the land, and bring back to finding ways to create, another way of security in order to have the liquidity. With the right liquidity, farmers can buy inputs, can buy good quality seeds, and then you can see a tremendous improvement in the production of agriculture. So that's all I wanted to say as an introduction, just to say that this is the core of the agricultural development, is the working capital financing. But with that, I would like to give the floor to Jean-Louis, who will tell us much more, and who does that all day long. So he has much more detailed and interesting, proposal to say, than me. So Jean-Louis, all yours.
No, thank you, Gilles. Yeah, good afternoon, everyone, and for the recording. I'm Jan-Louis van den Berg. I'm the CFO of Africa Merchant Capital. Just to give you a quick overview of how the working capital or trade finance fits into our group. So we're a UK-based private merchant bank, and we do a number of services. The core of the starting point of our services has always been corporate finance advisory, where we help companies in Africa to raise capital, and that ranges all the way from equity and growth capital to various forms of finance, from senior debt to working capital to structured finance, etc. Alongside that advisory business, we developed our own trade finance offering. It's a very specific offering, and I would like to take you just through a presentation which I think would be useful for viewers to see our criteria and the way we go about, and how specifically we fit into the market, and where we address some of those gaps that Gilles is mentioning. Unfortunately, not all of them yet. So as I mentioned, we've got the trade finance, which we'll go into in detail now, which is a structured trade finance offering. Advisory business is where we do capital raising. And asset finance, we've got a very specific operating rental model there that we are financing. So what is structured trade finance in our world and the way we do it? Some of the key concepts is we look for self-liquidating and secured structures. So self-liquidating is a very important aspect, where our loans are basically repaid out of the proceeds of the goods that we finance. So it's not a general working capital loan or an overdraft or a loan which you've got installment payments to make. but our actual repayments come from the sale of the goods that we finance, so hence self-liquidating. Secured, obviously, that we are looking at, it's fully secured loans, so we look principally at the goods as our primary security, and then that cash conversion cycle, so how the goods turn into debtors and how we collect those debtors. Every facility is bespoke. It's matched to the underlying client, to the specific trade flow, to the specific cycle of how the goods move, and how the offshore structures and the collections work. So we don't really have it's not a cookie cutter model which we replicate against many clients. We've got a small handful of borrowers, and every facility is very bespoke to fit to their underlying needs. As you can imagine, with commercial sales, tenors are unlikely to exceed 180 days. Typically, it's about 60 to 90 days. So moving goods from warehouses or even just before the warehouse through to the ports, onto the ships and out to the end buyers, and then getting that repayment back to the lender. So again, importantly, not a general working capital facility, but a very specific transactionally focused structured finance facility. On the security side, and again, as I mentioned, the main security that we take are the goods. We can either take a pledge over the goods in country, so looking at warehouse financing. Typically it's either the client's own warehouse, which is under third-party control, or with a third-party collateral manager, as an example, or we also finance in third-party warehouses. So typically your freight forwarding or your logistics companies can have warehouses, and we can finance at that point and take a pledge over the goods at that point. And then the second key part is receivables, where we look at an assignment. So if you've got an offtake agreement or a purchase order or a sales contract, and that contract gets assigned to us, the debtor would acknowledge receipt. So he would say, okay, I acknowledge your interest in these goods, and the payment then comes directly to us as lender, to AMC Trade Finance, and then we recover the loan in that basis. So our main focus as a group has always been Sub-Sahara, and mostly in the English-speaking countries, the Anglophone countries, so to speak. And therefore, a lot of our focus is in East and Southern Africa, and also, let's say, Ghana, Nigeria. We've done a lot of work there. We can also look at other countries, so goods coming out of Francophone or Angola or those kind of places. But then we are not that well set up to take in-country security. So our security and the point at which the transaction then starts, when our financing can start, is typically post-shipment. So after it's been shipped, the BLs have been printed, and then at that point we can finance, rather than financing goods in a warehouse in Côte d'Ivoire, as an example. So our basic criteria is Africa. Africa Merchant Capital, we're only focused on trades and goods flowing in and out of Africa, and certainly intra-Africa as well. Finished or export ready goods, so goods which are not still having to undergo processing or ripening or that kind of thing. So it needs to be harvested or finished goods, which is then ready to be exported. We can, obviously, if there's some rebagging or drying required, typically with the soft commodities in Africa, there's often drying and rebagging, etc. That is fine for us, but we don't typically finance goods which change shape. So, if you look at your fertilizers and the different ingredients coming in and mixes and products being developed, that change of shape or combination of products is a bit more difficult for us. But certainly if it's a trading, so most of our clients are traders, or traders or exporters who buy product which are ready to be exported, or who bring in product ready to be sold in the local market. Pre-sold is a very important requirement for us. So the transactional, because it's a transactional facility, looking at the stock and receivables as the main security, we don't want to take market risk or be exposed to market risk. So goods have to be pre-sold and with hard currency receivables. So if there are local currency receivables in Africa, then we would need to look at either making sure there's enough headroom or margin in the trade or buffer in those receivables, and we'd certainly look very hard at the liquidity requirements and the convertibility side, so making sure we can actually be repaid out of those local currency receivables. So most of our clients have got off-takers or debtors who pay them in hard currencies. We look for a repayment mechanism. So a key part of the security, which I didn't mention earlier, is we don't typically take fixed asset or personal securities or securities of the borrowers. So we look mostly or mainly at the transaction cycle, and therefore having a not being reliant on the client's performance to fully repay that transaction is an important concept. And that's why we call an acceptable repayment source is a key criteria for us. So that would include letters of credit. It can also include credit insured receivables. So you're selling to buyers who are credit insured, or then on a documentary collection to the banking system. Yeah, profitable trade. So the gross margin of the transactions need to be able to bear our cost of finance. And just to say on this point, our cost of finance is a bit more expensive than some of the international banks. So you have to make sure that the trades can carry our cost of finance and the cost as well. And then lastly, as we mentioned before, not general working capital, but the facility is used for specific transactions. LTVs is 60 to 85%. So the client, our borrowers and our clients have to be able to participate with a meaningful percentage of the transaction. We've got different product offerings, which I'll go through in a second. And then on client profiles, so just to give an idea, typically an exporter, importer, or a trader, sometimes a processor. We ideally want 3-year plus trading history. So we cannot do startups, but if you've got a slightly shorter trading history than 3 years, then let's certainly look at an application. Turnover size of our facilities are $3 to $10 million. Our typical facilities are around $5 million. So we struggle to get to a sufficient volume and utilization with companies with smaller than $5 million turnover. But we also look at companies who are fast growing with good market opportunity. So that's one of our criteria. And then, like any lender, asking for annual audited accounts, management accounts, we do a full due diligence on the borrowers, etc. So we look for track record with goods. We look for track record with trading partners and counterparties, with suppliers, with buyers. And that's an important part of our criteria. So product, we've got basically 5 different products. Pre-shipment finance is the most common one, where we finance export-ready goods, which are held at a warehouse, typically a third-party warehouse or in a client's own warehouse under CMA control, which those goods are already sold with acceptable offtake or sales agreements, and we would take security throughout that cycle from the warehouse to the vessel, to the documents, and all the way to the acceptable repayment source. Post-shipment is basically a step later. So as the goods are shipped on board a vessel, then at that point our financing starts. But again, you can have a period of finance there until the goods are cleared and paid for by the off-taker. Import finance is just the reverse. So we make supplier payments to suppliers who bring in the goods into Africa, and we will take security over those goods and be repaid through one of the repayment sources. Stock and storage finance is very similar to pre-shipment finance, but again, just looking at the goods in the warehouse. And receivables finance or discounting is basically in limited circumstances where it makes sense for our borrowers, where we can finance the debtors or the receivables and the invoices. So this is quite a simple example where there's AMC and we contract with our clients. So the steps that happens for this trade cycle to be executed, the client enters into a purchase and sale agreement with the suppliers and with the off-takers. The sales contract is then assigned to AMCTF. So we say, okay, we are happy with this off-taker, and that sales contract is then assigned to us. And then you start the shipment cycle. So the goods arrive in the warehouse. The client makes a drawdown request against the goods. So as the goods are certified and verified by a collateral manager, then we would finance against it. After that point, the goods are exported to port and then onto the ship out to the off-taker, and the off-taker makes a direct payment back to AMCTF. We recover the loan, and then we repay the profits plus the participation of the client back to the client. And then that cycle continues. So a lot of our clients, most of our clients are repeat customers or recurring utilization with recurring transactions. We like similar to a bank, we require full KYC and due diligence. We require financial standing to understand the financial standing of the prospective client. We look at the full operating history. We look at the insurances involved. We look at the contracts, etc., etc. So it's very similar. Our process takes about 2 to 3 months. So going through an application phase, we do an initial assessment. We give the client indicative terms to say, are they happy with the indicative terms that we are proposing? Then we complete our phase 2 due diligence and then prepare a full and final credit paper to be presented to the credit committee. This can take 2 to 3 months, and then at the end, you've got the legal implementation. I think that's just a quick overview, Gilles, of how do we do it. I think we fulfill a specific gap in the market in the working capital side where they're more established. Our market focus is the SME market, although the medium-sized enterprises in Africa typically qualify on a turnover and utilization basis. Yeah.
No, absolutely. But the SME must struggle to comply with all the conditions that you are required, like for example, audited account and this kind of thing. So what do you call SME? And are there any schemes? I mean, a few questions. I'll start with this one. But are there any schemes that you believe can help reaching the smaller companies? For example, are you dealing with cooperatives in the region?
Yes, we can finance the cooperative. So when the cooperative brings the various stock into their warehouse, at that point we can finance. But at the moment we're not set up for earlier finance. So that's a step, as I mentioned, a step earlier or in an area which we are not currently set up to do. So you're looking at different grant funding or local banking finance or other types of finance to get into that gap.
No, I fully understand that. What about the volumes of funding you are doing today in Africa, roughly, and number of transactions?
So the facilities are between $3 and $5 million, or between $3 and $10 million per facility. And over our history, we've deployed over $120, $130 million. So that's kind of the 20 to 30 clients that we've serviced over the time. And yeah, so we work with a small number of borrowers who can meet that criteria and we can add value to, and that's where we are set up and where our investor mandate is as well. Okay.
And in terms of countries, which are the countries that have been more using your facilities?
Yeah, a lot in West Africa, Nigeria, Ghana, Cameroon, but also in East Africa, we've done a lot in Tanzania, we've done some in Kenya, etc. So, and some in Southern Africa as well. So I'd say the biggest ones are Tanzania and Nigeria to date.
Okay. Where do you see the growth? I mean, what's your plan, in the next 5 years? What kind of volume would you like to achieve?
Yeah, we've got quite ambitious and high growth plans. We believe it's a good sector to be in, and there's a lot of demand coming through. With COVID and everything changing the landscape, the credit supply is even more constrained than before, and the disruptions and delays in some of the logistics is causing other lenders to take to be more cautious. So we believe there's a very big gap to be served in Africa, and we like to quadruple or more our volume and our throughput in the next 5 years. We've got the staff, we've got so our focus countries remain East Africa. We see a lot of potential in Tanzania, Uganda and Kenya, even Madagascar. We're looking at transactions there. Southern Africa, in the SADC region, we are speaking to a number of clients here. And then always West Africa has always got a big demand.
Okay. And you mentioned that you are doing both import and export financing. what is the more important sector? Is it more export or is it more import?
Yeah, export is much easier to tick all the boxes and to set everything up. We find that getting the acceptable repayment source, getting the certainty of the hard currency repayment for imports is more challenging. And if a client is, so we do mostly export finance, but certainly we do look at import finance transactions from time to time.
Okay. And you're not working with sovereigns, not with governments,
no, not at the moment.
Not at the moment.
We're working with a lot of the multilaterals to join forces and to co-finance or to arrange the right funding. And there's our biggest focus is food and agriculture as a business, but we also do other goods. So even mining, we can do some of those transactions, and certainly any consumer goods or specialized equipment, etc. So on the food and agriculture side, there's a lot of interest and activity from the likes of the IFC and Afrexim and even AFDB, etc. So we are actively collaborating and talking to all those organizations.
Oh, that's very good. This is very similar to what we used to do. I mean, you mentioned the warehouse receipt, program, which is again something we have introduced. But you need also to work with the government and to have the right legal framework that ensure that the system is working in the country. So that's where you can get help from the multilateral organizations. Now, the last question and the tough question for a banker: any default?
Africa is always have a few hiccups, and I think I don't think that I've not met a lender who hasn't had any hiccups. But we've also seen often it's not the fault of the borrower. So we then work with the customer, restructure it, and work it out to the best of our abilities.
Okay, very good. On my side, I think Jean-Louis' presentation was very, very interesting because it shows some people who were committed to take some risk. It's very clear that in the future, the governments working with the private sector will be very key. I would like to see some more risk-sharing schemes, for example, some more rural guarantee funds that would allow banks to go even further in their extent to the enterprises in Africa. The other point, which is where I started, is of course the size of the companies. The smaller companies are not equipped to be able to approach banks like Jean-Louis' bank, and that's a pity. I think the only way is for them to group themselves into cooperative. I am strongly believing that the cooperative sector is still very underdeveloped in Africa. I would like to see more partnership between cooperatives in Western Europe, for example, or in North America, and young cooperatives. And I would like to see the government working also on the law in order to ensure and facilitate the setup of cooperative, reduce the administrative burden, do some training, because this is the only way that these, this is what has developed the agriculture in every part of the world, has been mainly through the cooperative system, including in my own country. So I think that's very important for me. But I'll let Jean-Louis also give his vision.
I would encourage anybody who wants to apply for a loan just to go to our website and fill in application and leave yourself enough time, I think, is the advice. So make sure you start speaking to prospective funders like ourselves well in advance of your requirement. Don't leave it too late. It just takes time, even in this day and age with COVID at the moment, just organizing everything, it takes even longer. So the earlier you can speak to us, the better. And like Gilles said, we hope that over time we can help smaller companies as well. But there are different ways to do it, and you have to look to collaborate with others and partner with others. And I think the cooperative model and joining forces on that way is certainly a good way to do it.